Welcome to the CLS Monthly Market Review. I'm Rusty Vandeman, Chief Investment Officer at Orion, and with me this month, as the last couple months, Case Eichenberger, Senior Client Portfolio Manager for CLS Investments.
Hey,
welcome,
Rusty.
Case.
Thank you.
And Happy New Year.
Happy New Year. Happy New Year, everybody else. Yeah.
We have a lot to talk about, as we always do, we
do.
kind of have the monthly commentary, year-end commentary, decade commentary.
Yeah, and not prepared for the decade.
Oh, you're not? Okay, well, we got a lot to talk about anyway.
Yes, we do. Yeah. So I guess we can start with what happened last month.
It was a great month.
It was a very solid month. I mean, you kind of didn't really notice it day to day, but everything just ramped up towards the end there. Like emerging market stocks were up close to 7.5%.
Yeah.
Energy stocks were up 6.5%, I believe. Everything was positive except for when I looked back at it, real estate.
Yeah.
And bonds were about flat, I believe, or maybe a little bit negative for the month. But really what we saw at the end of this month, December 2019, was the laggards being, for most of the year, being the leaders. So energy, commodities, emerging market stocks all led the way in December, but for the year they were kind of towards the bottom. So we might see a rotation here, which is good.
It definitely seems like a turning point. It kind of coincided with the dollar. The dollar had some strength and it finally cracked.
Good point.
In fact, actually look at the charts of the US dollar. It really looks like it could fall a lot more. And if so, we'd see this rotation some more.
Yeah, because the dollar should benefit commodities producing countries, which are emerging market stocks. So that is a good correlation you've seen there for sure.
Yeah, absolutely.
But I guess as far as that, we started looking for outlook for 2020, right? And that's what everybody's kind of wondering. Okay, 2019's behind us. What do we do 2020?
Yeah.
So what do you have thoughts there for stocks? Maybe just get started.
You know, what's interesting is that even though most surveys right now show investor enthusiasm is pretty positive, pretty bullish on the market coming into the year, it's almost as I'm still getting questions on, like, this year can't be great because last year was so strong, or this year can't be great because it's the election.
Right.
You know, all these different reasons why it can't be great. But if we actually look at the historical precedents after a strong year like last year, usually the next year is still generally positive.
Right.
Usually election years, the market is usually up. So a lot of these reasons why people are sort of like down on the market for this year, actually it looks like it should be a pretty decent year. Probably not up 30% again.
Right, are we gonna get that? I don't know.
You know, we always want to be different and contrarian, but like everybody is saying, the U.S. market will probably be up, probably kind of a single-digit type return, and quite frankly, that looks about right.
Yeah, for next year. And international stocks, I guess we still are bullish on for better returns going forward.
Well, I do think that's where the opportunity is for long-term investors. The expected returns are just, I mean, if you look at the valuations, and again, how valuations work with expected returns, long-term returns, it really is a pretty high conviction view that international will do better over the next 5 to 10 years.
Definitely. What about bonds? Some of these diversifying asset classes.
Well, it's fascinating about the bond market. You know, a year ago, everybody hated bonds, and then bonds had a great year, and then this year, now everybody sort of likes them, and ever since they loved them, they've actually kind of suffered.
Right.
I mean, the reality is that, one, the overall bond market is expensive by all historical measures, and you've got to think that probably more likely than not, interest rates will probably go up this year. Not necessarily a lot, but they should go up. The other thing is that we obviously believe in an active approach to managing fixed income. We think you can add value by doing that, but virtually every sector of fixed income has been picked over. Everything is expensive.
Yes.
Particularly investment-grade corporates, high-yield bonds, preferreds, they're all super expensive. About the only thing that seems sort of average-ish compared to long-term is like emerging market debt.
Yeah.
We obviously have exposure to that.
Exactly.
And muni bonds as well.
Yeah, I mean, investment-grade corporates had a phenomenal year in 2019. We look back, they're up over 15%, 17%. I mean, gosh, they were negative in 2018, but nonetheless, they had a great year. So spreads are very, I guess, tight right now, we could say, for
the bond market was up nearly 10% last year, too, the overall bond market. That's a phenomenal year. It was a phenomenal year for any investor last year.
It's ho-hum compared to the 27-30% you get for stocks, but we'll take that for...
Hey, but 1/4 of the risk, so still better risk-adjusted performance.
Absolutely.
You can look at it that way.
Absolutely. So I guess kind of pivoting a little bit, looking more for opportunities, we've talked a little bit about kind of trends and how technology has been shaping new trends for the environment, for the investment landscape. What do you see there? Is there an investment case for those?
There is an investment case, and thanks for tying into that, because CLS is coming out with a strategy this year kind of related on mega trends. And megatrends kind of falls under this thematic investing, which is very interesting for a lot of different reasons. I mean, first of all, thematic ETFs, for instance, such as looking at technology disruption or emerging wealth overseas or resource scarcity or all these different megatrends. There are some really interesting things about it. First of all, they had higher growth rates. Obviously, the story is resonating with investors. Part of the reason why it's resonating is performance has been pretty strong, so that's attractive as well. Also, in terms of building a portfolio, what's really interesting about these megatrends is that a couple of things. One, they actually have lower correlations to the overall market than you might think. You can actually get some diversification. So it's not just return potential, but you can also manage risk in a portfolio. The other thing about some of these thematic ETFs, which is really an interesting twist, is that when you're building a portfolio using traditional asset allocation, a lot of these thematic areas are kind of like just industries. They're not sectors yet. So it's kind of hard to get exposure to them if you're doing it through conventional ETFs or mutual funds or whatever. But when you actually use thematic ETFs, you get that exposure.
That's, I think, was a big one for me taken away when you just look at exponential tech or whatever you want to call it. You think it's all tech, it's maybe global tech, but it's a lot of healthcare, maybe some industrials, and there's different ways that ETF providers are coming out with solutions there.
These are the industries that are changing our economy, and it's nice to have exposure to it.
Absolutely. So did we hit the outlook, I guess?
One thing you didn't talk about was the election. You get questions all the time about it. Well, as you know and I know, is the election will probably cause some volatility this year, as it always does, particularly if the outcome is uncertain. But as we also know, it tends to be an overrated factor. I think a lot of people are like, how can that possibly be? It's like easy to connect dots. But it's so true, is that there's usually other variables that really determine what the market's going to do. Obviously, presidents can have impact on the economy to some extent, but really they're things just bigger than that. And as we know, working with investors over time, think how many people bailed when Trump was elected. Because they didn't like Trump.
A few of those calls,
But think about before that, how many people bailed because Obama was president.
Exactly.
And so letting your political biases influence your investment portfolios almost never works.
Try to keep them separate, right? We always talk about that, but nonetheless, they always creep into conversations. I mean, we just had the holidays, right? So that's what everybody's kind of talking about and want to know opinions there. So that's good to know. Speaking of talking to investors, we often talk a lot about, obviously, outlooks, but we talk a lot about how investments are being managed. Are you an active manager? Are you a passive manager, or strategic or tactical? Can you maybe get into a little bit of that, of how Orion and CLS thinks of that?
Great question. And well, first of all, successful investor experiences are really about managing expectations. And a lot about managing expectations are making sure everybody knows the terms. If you're using a term, everybody should understand what that word really means. And it's nice you bring this up because I'm writing about it, but you also wrote a white paper a few years ago.
A few years ago already,
which I think is really one of our most relevant white papers because it defines some of these terms that I'm writing about as well. So for instance, there's the difference between active and passive, which I've written about a lot before, but really simply put, a passive strategy is trying to match a benchmark, and an active strategy is different than the benchmark because it's trying to have a better risk-adjusted performance over time. So again, one's the benchmark and one is trying to be different than the benchmark. Really key definition. And then another definition, two definitions I go through because these words are often misused, but they're really important words, are strategic and tactical.
Yeah, I agree. They can mean so many different things.
I mean, we're dealing with all the time. We spend a lot of time in conversations trying to explain what it is. Basically, the simple definition of strategic is managing to a target. It could be a target asset allocation, but of course at CLS we're managing a target risk allocation. Tactical, meanwhile, is large changes in the composition of the portfolio, which means the equity allocations can change a lot, the risk allocations can change a lot. It's different than strategic all the way. Now, a lot of people, when it comes to strategic, it could be both either active or passive. It kind of fits, everything fits underneath that. And tactical, meanwhile, is an active strategy, but it's a subset of active. Most active strategies are not tactical. So I think that's the key difference between them.
Purely, I like that, strategic managing to a target, because that is what we do. We are strategic to the risk, but we are active within the asset allocation and the risk allocations that the assets bring us. So tactical, mainly meaning huge changes, maybe going to cash or something like that. So last, maybe active or beta, I guess, and alpha are two I hear a lot. And then maybe diversifier and alternative are also coming up more now.
So I did write about those. I did write about some other terms above and beyond all these too, but beta and alpha is a good one. Beta actually there's a lot of fancy definitions for it, but basically beta means the market.
Right.
If you want market exposure, you want to participate in the market, you want
is.
beta.
Yeah.
You know, so in a bull market, you want beta. So there's different market cycles. So in a market cycle where the market's going up, you want beta. In a market environment where there's opportunities to enhance returns above and beyond the overall market, you want active strategies. And then, of course, that's just all thinking about equity exposure. And then to diversify a portfolio, you want diversifiers. And so within diversifiers, there's a couple different asset classes that fall underneath it. One is fixed income.
Sure.
The
ultimate. Yeah.
the ultimate the way to diversify equity risk.
Yep.
And the second is alternatives. And so getting back to beta versus alpha, we don't talk about alpha so much, but it's an important word. Basically, alpha is sort of the excess return a manager brings to a portfolio above and beyond beta.
Got it.
Another fancy way of just saying excess return.
Definitely.
But anyway, so it's these are all key words depending on, and then strategies fit different market cycles. So again, just to restate it, if you want to participate in a market that's going up, you want beta. If there's opportunities to enhance returns above and beyond the market, you want active. And diversify all this, you want diversifiers.
Perfect. Well, sounds like we're pretty well prepared for 2020, I guess, right? I mean,
I hope so.
There's a lot more questions, obviously, in the commentary that we didn't get to, but those are kind of the main ones that we talk about.
Well, thanks, Case.
Yeah, thanks.
And thank you for your time and trust in CLS Investments, and we'll see you next month.